What happened during those 4 hours wasn't a normal market move, and anyone who's been watching silver closely knows that instinctively. A $15 drop doesn't come from miners suddenly flooding the market, and it doesn't come from industrial users backing away all at once. It comes from paper, layers of leverage stacked on top of each other, unleashed at precisely the right moment. This was a paper shock, not a physical one, and the speed alone tells you everything you need to know about where price control really lives. Silver trades in two very different worlds at the same time. There's the physical market, where real metal changes hands slowly, deliberately, based on actual need. And then there's the paper market, where contracts representing massive amounts of silver can be sold in seconds, regardless of whether that silver even exists in deliverable form. When those paper contracts hit the market all at once, especially during low liquidity windows, price doesn't discover anything. It collapses. That's exactly what we saw. The selling didn't roll in gradually. It hit like a wall. Large blocks of futures contracts were dumped into the market in rapid succession, overwhelming buyers instantly. Once that first wave hit, algorithms took control. Stop-loss orders triggered automatically. Margin thresholds were breached. Forced liquidations kicked in. And suddenly the selling wasn't voluntary anymore. It was mechanical. Traders weren't choosing to exit. They were being ejected. This is how modern markets accelerate panic. Human decision-making gets replaced by code, and code doesn't hesitate. It doesn't look at fundamentals. It doesn't care about physical shortages or long-term demand. It responds to price signals. And once those signals turn negative, the cascade feeds on itself. Every dollar lower creates the conditions for the next dollar lower. In silver's case, that feedback loop ran unchecked for hours. What makes this even more revealing is what didn't happen. Physical demand didn't vanish. Industrial consumption didn't suddenly collapse. Mints didn't stop producing. In fact, in many places, premiums stayed firm or even widened as paper prices fell. That disconnect tells the real story. The crash wasn't reflecting reality, it was overpowering it. Paper volume drowned out physical truth, and that imbalance isn't accidental. The silver market has been structured this way for decades, with paper contracts far exceeding the amount of metal that can realistically be delivered. That structure works as long as confidence holds and leverage stays manageable. But when large players decide to move size, especially during thin trading hours, it exposes just how fragile price stability really is. The market doesn't bend, it snaps. Timing matters here too. These kinds of moves don't usually happen during peak liquidity when real buyers can absorb the pressure. They happen when participation is light, when spreads are wider, and when fewer bids are waiting below the market. That's when it concentrated. Sell-off can do maximum damage in minimum time. This wasn't random timing. It was optimal timing. Once the price started falling fast, psychology took over. Retail traders panicked. Smaller funds scrambled to reduce exposure. Anyone using leverage suddenly faced margin calls they hadn't planned for hours earlier. And when margin calls come, positions don't get negotiated, they get liquidated. That forced selling added fuel to the fire, pushing prices lower not because people believed silver was suddenly worth less, but because they had no choice. This is why these crashes feel so violent and so unfair. They're not driven by a collective change in belief. They're driven by structure, by leverage, by rules that punish weakness and reward size. When the dust settles, the metal doesn't disappear, it just changes hands. Those who were forced out sell at the worst possible moment, and those with capital and patience step in quietly on the other side. That's the part most people miss. These events look like destruction, but they're also transfers. As the price collapsed, contracts didn't vanish. They were absorbed. Stronger balance sheets, deeper pockets, and longer time horizons allowed certain players to accumulate positions at levels that would have been impossible days earlier. Panic creates opportunity, but only for those positioned to survive it. And this exposes a deeper truth about silver pricing. The price you see flashing on the screen is not a pure reflection of supply and demand. It's a reflection of leverage tolerance. When leverage gets unwound violently, price becomes a casualty. That's not a flaw in the system. It's how the system is designed to function under stress. This is why explanations that focus on news or sentiment fall flat. No headline justifies a $15 move in hours. No data release explains that velocity. What explains it is a market dominated by derivatives, where paper volume can overwhelm reality faster than most people can react. Once you see that clearly, these crashes stop looking mysterious and start looking inevitable. The real shock isn't that silver fell so fast. The real shock is how easily it happened and how exposed the market becomes when paper is allowed to dictate price in moments that matter most. What really matters isn't just how fast silver fell, but what that fall exposed about who actually controls the market when pressure hits. In calm conditions, it looks like silver is driven by miners, manufacturers, and long-term investors. But the moment volatility explodes, that illusion disappears. Control shifts instantly to those with the deepest liquidity, the strongest balance sheets, and the ability to survive chaos while everyone else is forced to react. This crash wasn't just a price event, it was a transfer of influence happening in real time. When silver dropped that hard, that fast, weaker participants didn't step back by choice. They were pushed out by margin calls, risk limits, and liquidity constraints. Hedge funds hit their maximum drawdowns. Retail traders saw accounts wiped out. Smaller institutions were forced to reduce exposure to stay solvent. None of that was strategic, it was defensive. And while that scramble was unfolding, something else was happening quietly underneath it all. Large institutions weren't panicking. They were watching. They had the capital to ride out volatility, the access to credit when liquidity tightened, and the patience to let the chaos do its work. As selling intensified, they didn't chase the price lower emotionally. They waited for forced selling to peak. That's when accumulation happens, not during stability, but during distress. This is how control consolidates in modern markets. Volatility isn't just risk, it's a sorting mechanism. It determines who can stay in the game and who can't. When prices collapse rapidly, the market doesn't become more democratic, it becomes more centralized. Positions move from many smaller hands into fewer stronger ones, and once that shift occurs, pricing power changes with it. What made this crash so revealing was the speed. 4 hours was all it took to redraw the landscape. That kind of move doesn't just shake confidence, it removes participants entirely. After an event like this, the market looks the same on the surface, but underneath it's thinner, tighter, and more concentrated. Fewer players control more exposure, and that gives them influence over how the next move unfolds. This is why rebounds after crashes often feel strange. Prices don't recover in a way that feels natural or fair. They stabilize abruptly, sometimes without obvious catalysts. That's because the market has changed hands. Once weaker positions are cleared out, volatility drops, not because risk disappeared, but because control has been consolidated. The people still standing don't need to panic. They dictate the pace. And that brings us to the uncomfortable truth. These crashes are not accidents, they are stress tests. They reveal where leverage breaks, where liquidity fails, and who is forced to sell under pressure. Every major institution watches these moments closely because they provide information you can't get during normal trading: who folded, who held, who was forced out at the lows. That data is invaluable. This is also why these events tend to repeat. The structure rewards those who can manufacture or survive volatility. If you have the scale to absorb losses temporarily, you gain long-term advantage. If you don't, you eventually get shaken out. Over time, that dynamic concentrates power into fewer hands, making future moves even more asymmetric. The next shock becomes easier to execute because resistance has already been weakened. What we're seeing in silver isn't unique. It's just more visible because the market is smaller and more leveraged relative to its size. That makes it more vulnerable to rapid repricing and more efficient at transferring control during moments of stress. When panic hits, silver doesn't just reprice, it reorganizes. And this reorganization has consequences. With fewer participants and more concentrated positions, price becomes easier to move. Volatility doesn't disappear, it becomes more controlled. Sudden drops and sharp rallies both become more likely because fewer players have the power to influence direction. That's not stability, that's dominance. This is why focusing only on the dollar amount of the crash misses the bigger picture. The $15 drop wasn't the story, it was the mechanism. The real story was who survived it and who didn't. The market didn't break, it filtered. And once that filtering process is complete, the rules change. Those who remain after a shock like this are not the same participants who were there before it. They are stronger, more capitalized, and less sensitive to short-term pie. That shifts how silver trades going forward. Price becomes less about broad participation and more about institutional positioning. And when that happens, moves tend to be faster, sharper, and less forgiving. This is why moments like this should never be dismissed as random volatility. They are inflection points. They mark transitions in control that most people only recognize after it's too late. By the time confidence returns, the market has already been reshaped, and the opportunities that existed before the crash no longer look the same.